training program that's free for anyone in BC if you want to figure out, validate your idea, get some best practices around starting a company. And we also have what's called the ISI grant program, and that's for companies hiring a post-secondary student. You can get up to $10,000 of matching salary in cash to help you make that happen. So that's us in a nutshell. My computer is beeping like crazy, so if you hear all these beeps, I apologize. I want to quickly just thank our sponsors. So we have, we're feeling super fortunate because, for one, we were able to move all of our competition offerings and our education seminars all online here as we continue to go through COVID-19. And we're also super grateful because we've had a really great reception and engagement from everyone, including everyone who's attending here, and our sponsors. So I'm just going to quickly go through our sponsors who have been super supportive to let us keep moving here. So our title sponsor is Innovate BC. Our gold sponsors are EY, Fakun, SFU BD School of Business, UBC Sutter School of Business. Silver sponsors are Vantech, Volition, and TELUS Ventures, and our bronze sponsors are Ace Tech, BC Tech, Spring, and webnames.ca. So if you do have any questions around anything I just discussed around our programs, feel free to reach out through any of those different channels. And we're also online here today, so feel free to message me in the chat or the Slack group. At the end of today, there's also going to be a survey that Kayla will send out to you. I'm told it takes like 15 seconds or so. So really, we like to capture as much feedback as we can so we can continue to iterate on the education offerings. So before I pass it over to start the talk, I just wanted to say hello to our speakers. So Jonathan Conlon, Samuel Lee, Hardeep Gill, hello virtually to you all. Fakun, the law firm, has been a supporter of New Ventures BC for, I have to look it up, well over 10, 12 years for sure. And in a typical competition year, they not only donate their time for seminars like this one to work with startups, but they also help us with hosting different events for the competition at their office space. And they also, part of the big prize packages at the end, if you do win, does include in-kind services from Fakun. So I would say Fakun does so many things to support the tech startup ecosystem here. So we're, as always, very grateful to them. So with that, I'm going to let this team of lawyers here tell you all about corporate structure. So I'll pass it over to you guys right now. Thank you.
Thanks, Angie. This is John Conlon speaking. It's really nice to I guess, meet everybody. I'll turn my webcam on briefly just so that everybody can see me. So hi, this is John. I'm one of the partners in Fakun's technology group, practice consisting predominantly of a range of corporate finance work and then M&A work. So the average day and week for me looks like helping very early stage startups all the way up to doing complex financing transactions, later stage VC financings, and complex M&A work, typically on the sell side. Very nice to be speaking to all of you, and look forward to the next couple hours.
So I'm Samuel Lee, partner in the securities group. Half my practice would be kind of public security stuff, so working with public issuers listed typically in a variety of industries, but half my practice is similar to John's, private M&A, private financings across the board. So today I'll be focusing on the securities aspects mostly.
My name is Hardeep Gill. I'm a tax lawyer at Fakun. I generally practice in all areas of tax, predominantly on income tax stuff for private companies and sometimes their employees, and some public company stuff, but like less. And then I also do some work in the GST area, although less than income tax. Yeah, so I look forward to talking to you guys.
Great. So I think we'll get started here. I thought what we would do is just kind of provide some introductory comments about what we're going to take you through. As you would have seen in the materials that went out before today, our talk is predominantly going to focus on a very basic introduction to corporate securities and tax issues for startups. And then within that, what we want to do is we want to hit a lot of the kind of key points that we think are valuable to fit into 2 hours, but we also want to leave a lot of time for questions. And so I know that we've built one break into the middle. We're also going to have questions at the end, but if anything's burning, I suppose please type it into the chat as Michaela indicated, and perhaps we can address them as we go. First, I wanted to give you a little bit about who Fakun is. So Fakun is the largest law firm in British Columbia. It's a full service law firm, so we practice in all areas, save for a few examples. For emerging companies specifically, we've been focused on that area for well over 2.5 decades, and so we bring quite a bit of experience to helping startups grow and succeed, and not only with respect to kind of core business and corporate law issues, but also surrounding issues. We have specialists in securities like Sam, specialists in tax like Hardeep, and also in litigation, employment law, and a variety of other areas. So really what we try to provide is a full team approach to the expertise that a company needs to start, grow, and then ultimately realize on its business plan. In today's lecture, we're going to focus on kind of two predominantly kind of overall topics: corporate structure and legal agreements. Many of you are probably thinking about issues related to COVID-19. Obviously, we live in unprecedented times, as you've heard over and over again. We have turned some of our presentation today to face some of those issues. So Hardeep's going to take you through some of the COVID-19 programs at a very high level, and we'll include some links to additional information where you can go and learn more about some of those programs. And Fakun has provided some summaries online that you can access in that regard. So to kick things off, so the first thing we want to talk about is corporate structure, and when we're talking about corporate structure, we're looking at very initial questions you're asking. So you're saying how and where do I set up my company? Who owns it? How are we going to attract talent to grow the team? And how are we going to attract money to pay those people and grow the business? The other heading will be what legal agreements are involved in this. Obviously, we're 3 lawyers talking to you, so a lot of what we give you is the legal side of all of these issues. Internally, so documents within your company, many of which you'll be encountering at the outset of starting a business, things like shareholders agreements. That's an agreement governing the ownership of shares as between you and your other shareholders. IP assignment agreements, making sure that the right party owns intellectual property that's created during the business, but also potentially before you even incorporate. Consulting and employment agreements, making sure it's very clear the rights and restrictions around which people are engaged by the business. Reverse vesting agreements and other agreements that deal with the ownership of securities. A reverse vesting agreement would be one example where if you have 3 founders sitting around a table and you've all decided to start a business and perhaps you've all decided you all own a third, what are the assumptions that one of the assumptions you're making there is that you're all going to dedicate a lot of sweat into that equity. And so what happens if that doesn't become true and maybe you need to recalibrate that ownership structure? Externally, term sheets, NDAs, license agreements, etc. Not only on the commercial side of things we want to use to protect our secret sauce, things we want to use when we're making our first, when we're entering into our first contracts with customers and other commercial partners, but also on the financing side, and we'll get into that. So we did want to touch very quickly on the options you have to start your business. Many times when we're speaking to founders and they're considering how to organize their business, they come to us and they say, well, I know that having a corporation is the most common approach, but somebody told me that a JV might work, or my accountant told me it'd be much simpler to just have a sole proprietorship. So we wanted to just take 1 minute to touch on different options for association. So what a sole proprietorship is functionally you as an individual performing all the functions required for the business, and you're assuming all the liabilities. And while that may be in a way lower startup costs for you and potentially some tax advantages, it also carries unlimited liability, and as well it drastically limits your ability to raise capital, incentivize employees, and access government programs. A partnership is at law when two people are carrying on a business with a common view to a profit. Partnership can be a general partnership in which both partners have liability for the debt and obligations of the partnership, and those liabilities are unlimited and joint and several. A partnership could also be a limited partnership in which one of the partners has this unlimited liability I talked about, and the other partner's liability might be limited to what they contribute to the venture. So you often see this when you see limited partnerships being referenced in venture capital. Investors become limited partners. They invest capital into the venture capital firm, and that is really the extent of their stake in that enterprise, the VC going out and investing in companies. A joint venture is kind of broadly described as two parties joining forces to carry out kind of a specific project. You may encounter this if you've run into a similar business or a business where that has a complementary piece to what your widget that you're building is, and the two businesses say, well, it'd be nice to somehow join forces, but we know we don't want to merge or do something that is represents an overall integration of both businesses. We just really want to focus on this one project. That's often when you see a joint venture being used. It's in our experience, it's not the right structure to be used for a business itself, but really a one-off project-based approach. A corporation is really where most technology businesses start their life, and it's where it's always our recommendation, absent very unique circumstances, as to the legal entity that should be formed. There's a whole bunch of benefits to having a corporation that we'll get into. A corporation is a legal entity separate from those who own it, being the shareholders, and those who operate it, being the directors, officers, and employees. And we'll talk about all of those different types of actors within this scheme. And while the structure might be somewhat more complicated, it provides the platform upon which you can build all of the rights and restrictions that investors might expect and require when they invest in your company, that can be used to allocate the equity ownership of the company as amongst your employees and other stakeholders. And it can also put you in compliance with requirements for various government grants and other programs.
Okay, so our first topic here is the structure, talking about the structure of corporation. What we have in this slide is basic corporate structure. So it involves, as John kind of mentioned, you have your shareholders at the top, who are really the owners of the business. In this kind of simple example, we have one of the shareholders also holding through a holdco. The box in the middle is really the company, so that's made up of the directors, officers, employees, and then you have your external panel, which is outside of the company, advising the company. We'll go more to that. This structure, shows one of the first advantages of a corporation over, for example, sole proprietorship, in that it lets you have multiple owners in the company. And the benefit of that is obviously you can sell shares of the company to raise capital. So on shareholders, John, the next slide. Starting with the shareholders, shareholders are typically understood to be the owners of the company. Shareholders become shareholders because they buy shares of the company, which effectively gives the holder a bundle of rights, and it gives the company funds to operate the business. Shareholders can really be any type of legally recognized persons. So this would be individuals, companies, including individuals who hold through a holding company, partnerships, etc. Really, it comes down to the characteristics of the shareholders who are investing. There's also no rule on how many shareholders a corporation can have. So generally speaking, the more shareholders you have, the more the ownership will be diluted. And as the ownership becomes diluted, there become practical challenges just with managing a larger shareholder base. So we often would think that fewer number of shareholders is preferable, but of course, the more shareholders you have means you probably have raised more capital or potentially raised more capital. Another consideration on number of shareholders is there are a number of thresholds that are based on how many shareholders you have. We know here a threshold of 50 shareholders. That is a threshold, although it depends on a number of factors, including which shareholders would be counted for that threshold. But so that's another consideration. And so before you start rushing out and trying to raise some money, there are rules on how you find shareholders and who you can sell to, and that really goes to the securities laws. Those rules get quite complicated, so we would suggest seeking advice of a lawyer. So next slide. As I mentioned, being a shareholder means you own a share. And what this really means is you have a bundle of rights that are attached to the share as a shareholder. These rights are typically what we would associate with owning the company. And one of the main benefits of this corporate structure is what we have here on the first point, which is that shareholders have limited liability. Their liability is really capped at what they've invested in the company, or typically capped at what they've invested in the company. There are some outliers, including certain contracts the shareholder may enter into. The bundle of rights a shareholder has really depends on the rights and restrictions attached to those shares. So again, that's one of the other advantages of a corporation is really you can frame the bundle of rights kind of how you want to. So we have some examples there. The basic share is typically a common share, but you can also have what they call preferred shares, which have certain preferences over the common shares. They can be non-voting shares or voting shares. Common shares or preferred shares can be voting or non-voting. For example, or a non-voting share, for example, this would allow you to have completely passive shareholders for the most part. They will have certain voting rights, but generally they don't get a vote on the typical manners. On top of just voting rights, you can add on top of this certain super approval rights held by certain classes of shares, for example, such as increasing the size of the board or taking large debt financings, things like that. You can have rights as they relate to dividends. Practically speaking, typically a private company won't issue dividends, in particular in the startup stage, as you'll be wanting to use that money to invest in growth. However, if in later rounds of financing, investors may require a preferential dividend attached to the shares they buy, which would be paid out on things like an exit or liquidation, things like that. You can have participating, non-participating shares as well, which basically means do they get a piece of the upside when you sell. Non-participating would typically mean that they're capped at a certain return or for example, an extra dividend, a preferred dividend, whereas participating would mean that they basically get what's remaining after you've paid out all your creditors and your advanced shares. And then lastly, we have things like preemptive rights, anti-dilution, down round protection. These are all really protection for later rounds if your investors require it, that let them keep their percentage of the company or give them for down round protection, really give them certain advantages if you continue to have financings at a lower valuation. So really what this shows is, you can almost do whatever you imagine up in many respects with shares, just by fixing their rights and restrictions. So we got the next page here. There can be other, just keep in mind that there can be other rights that aren't attached to the shares, but are contractual rights. So if, for example, a shareholder enters into a shareholder agreement, they would have to be governed also by the shareholder agreement. The difference being the shareholder agreement is applicable to whoever signs the agreement as opposed to being attached to the shares. So here we got some other documents. The articles would be applicable to all shareholders, but the things like shareholders agreements or subscription agreements, really those are contractual rights of the company and with your shareholders. And on that first point, the exclusive right to elect directors, that is in the purview of that is the main right, one of the main rights of shareholders, that they are the ones who set the directors, choose the directors. And John will kind of go through what that means.
Right, thanks, Sam. Sorry, I jumped ahead there on the slide on you. So the next topic we're going to discuss is directors, and here we've called them the policy setters. Directors are responsible for the overall management and direction of the company. At a more mature phase of the company, they're usually not mostly consisting of employees, although I'm sure many of you are listening to this thinking, well, hold on a sec, I wear every hat because I am the company, and that's entirely expected at an early stage. The amount of time that a director dedicates to the company is often a part-time role, and can increase during kind of important points in the company's life cycle. But when we grow into our kind of growth stage companies, you're looking at people dedicating one meeting a month or a quarter, and that is the level of engagement that you see. Directors are elected by the shareholders, and many of you will be familiar with the concept of an annual general meeting. Typically, companies in Canada have their shareholders elect their directors on an annual basis. Of course, shareholders can also elect directors in writing if the shareholders agree to elect the directors through a written resolution. And there may be instances such as financings and other events where outside of the normal yearly cadence, directors are added or removed from the board. Also, directors themselves can fill vacancies. In many instances, if somebody leaves the board and you used to have 5 and now you have 4, the remaining 4 directors can pick the 5th one and resolve to add them to fill that what's called a casual vacancy. And also in certain instances, the directors themselves can increase the number of the board. So in many cases, that those same 4 people can add 1, or those same 5 people can add 1 to make it 6. You do have to have at least 1 director. In BC, there's no residency requirement. That is a contrast with our federal statute, which says that at least 25% of the directors have to be resident Canadians. Oftentimes, that's a consideration, especially if we have people that would like to start a business in BC, but may, for some reason or another, be resident outside of our country. And then with respect to qualifications, it's very basic. You're not allowed to be convicted of a criminal offense or be a bankrupt or be under 18. There's no ceiling on the number of directors, but of course there's a practical limit. Much like there's many challenges from a governance and administrative perspective with having hundreds of shareholders, there's also the similar challenges with having way too many directors at the table. And there's also challenges with having even numbers of directors if there's deadlock and things of that nature. What do the directors have? Directors have the power to manage the affairs of the company. They can determine policy. Directors approve the yearly financial statements. The directors can hire the auditor and can set various policies, hire and compensate management, and things of that nature. Always consistent with their management, with their oversight of the company. They have duties. You'll hear of, often, and you'll see in online literature that you may have come across, that directors have fiduciary duties. Directors have a duty to the company and the shareholders to act fairly and diligently, and that is a well-established duty that directors have at law. Directors also have potential personal liability in rare cases, breaching those fiduciary duties that I just mentioned. And also in some cases in respect of unpaid taxes to CRA, unpaid wages to employees, and some other limited areas. One of which that's BC specific in some cases would be for EBC tax credit liabilities that need to be repaid to the government and that were not done so. Directors, as I mentioned, have the ability to appoint the officers of the company. Here we've called the officers the instructors. These are the senior management personnel of the company appointed by the directors. Again, you can have as many as you want, and you can have any titles. Many of you will have come across, larger technology companies where they have a chief imagination officer, a chief inspiration officer. All indicators that you can be as unique as you want in setting titles. Although a basic set of officers you would want, or president, somebody that's in charge of the technical side of your business, perhaps a chief technology officer, somebody that's in charge of the finance side of your business, perhaps a chief financial officer. Many times co-founders will come in and they'll say, well, we both want to be officers, but we don't want to give any, we want to be completely equal. And so they're worried that a president might be better than a CEO or vice versa. So in many cases, the way that that's handled is co-CEO or co-president. So really there's a lot of flexibility here is the takeaway. The next slide is in respect of employees, and I'll turn it over to Sam.
I mean, obviously most of you will have the understanding of the concept of employee. The employer has the right to direct and control the type, manner, and timing of employees' work. The employees will have certain entitlements under employment standards law. For example, minimum wage, overtime, vacation, statutory pay, things like that. And in BC, employment laws are quite strong. Employees can be characterized as either indefinite or fixed term. Indefinite being, you have an established start date, but there's no real end date. Employment would end until one of the parties decides to end it. Fixed term would be having an established start and end date, 1-year contract. And of course, you can be full or part-time. Employers do have statutory obligations, which is kind of what I was mentioned before. In addition, there would be requirements to deduct from salary a certain portion or have due remittances. They would also be responsible for any notice and severance requirements prescribed under the employment standards legislation. There are minimums in employment standards law. So employment agreements, oftentimes, startup companies won't have employment agreements. They'll basically hire someone with a one-pager saying, "Congratulations, you're hired. This is terms of your employment with basic wage or what have you." In our opinion, it's always important to have employment agreements. It's just smart to have them in place. It provides certainty on various entitlements. In particular, it can have certainty on severance payments. And this could, one, provide certainty, but also potentially prevent some unknown liability in the future. For example, on the severance front, without a clause in the agreement, severance could be determined by common law, which can be quite high. For assignment of intellectual properties, for technology companies, obviously in particular, but anyone creating any sort of IP, or even if not, there is usually a presumption in law that an employee creating IP to an employer, it would be owned by the employer, but that's just a presumption, and that this is why you typically would want some sort of IP assignment in the employment contract which basically says that anything created by the employee is owned by the employer. You can have things like non-competes or non-solicits in employment agreements, although in particular, non-competes are pretty hard to enforce unless they're the individual is very specialized or very high up, has a lot of sway with the company, and you would need to narrow it quite non-solicits and non-competition would basically say that certain employee X, if they leave the company, can't work in a certain defined competitive area for a certain amount of time. And generally, the law doesn't like broad non-competes because basically it doesn't allow the employee to work once they've left your company. So you're kind of a slave to the company. Non-solicits are more common. They say you can't go out and communicate with or try to take away my customers or employees or something along those lines. That would be a little more common. The next slide is about consultants. So in differing with employees, independent contractors are not employees. They don't have employment status. Although just because you call someone a contractor doesn't necessarily mean that they are. It really just goes to the relationship. Although a contract would obviously help. They aren't entitled to participate in traditional employee benefits or other benefits prescribed under employment standards legislation. Independent contractors usually assume the risk of having the project or assignment canceled midstream. They usually retain control over how and when they do the work. They are typically allowed to work with multiple companies at a time, although it depends on the agreement. They'll typically own their own equipment, or it'll be stipulated in the contract that they get access to certain equipment. Oftentimes, the contractors will submit invoices to the company for payment of work, as opposed to a kind of bi-weekly paycheck as you see with employee. There are certain requirements to register with the CRA for HST, GST, but that's requirement of the contractor. The company, another difference is the company isn't typically required to withhold or collect and pay certain taxes or remittances to the CRA for a contractor. And a company wouldn't be obligated for notice or severance obligations under employment standards. Usually there will be a provision in the agreement that kind of talks about giving certain notice or what have you, how you can terminate the agreement. Consulting agreements are more common than employment agreements. Go to the next slide. These are some of the similar standard, some of the more similar standard provisions in a consulting agreement. On the IP assignment for contractors in particular, you probably want a more onerous IP assignment requirement because there isn't that automatic flow of IP from employers, or at least presumption from employer or employee in a contract, on a contractor relationship. So I think we're going to pass it over to Hardeep to explain some of the tax differences in consultants.
Yeah, thanks, Sam. So Sam mentioned that consultant agreements are more common than employee agreements, and one of the main reasons for that is that CRA tends to look at this relationship quite closely, particularly when a payer and a worker say that the worker is a contractor or a consultant, because, well, often the relationship is not any different from an employee relationship, in which case the employer is required to remit payments to CRA on account of like EI or CPP and whatnot, which they don't have to do for consultants. And so in that case, you want to be sure that your consultant is actually a consultant, and an agreement goes a long way towards demonstrating that. So in terms of taxes, well, the consultant is considered to run his or her own business, and so they have business income. They're able to take deductions. and like, you know, any other expenses that you know, a business might have, well, they're able to deduct those. Employees, well, they earn employment income, and there are very few deductions that they can take, and the tax rules that apply to them are very restrictive. However, they get security in the sense that they'll continue to have a job. Like the employer cannot you know, end the employment relationship without you know, meeting like the notice provisions and so on. And so in terms of compensation, there's 3 different ways that each of employees or consultants can be paid. Generally for employees, like anything that they receive other than shares or options is treated as if it was cash that they were receiving, which is that anything that received is considered employment income, and that has to be included in the employee's taxable income. So the reason why shares and options are like taken out of this portion is because, well, they're treated very specifically and very differently under the Income Tax Act. So if an employee receives shares, generally, well, in the small business context, anyways, there's no tax that's payable at that time. There's a deferral of tax. So it's as if they haven't received anything yet. It's on the sale of shares that there would be a tax consequence. Where the employer, the company is actually like a bigger company, say it's like a public company, or if it's like controlled by a foreign party, then like a receipt of shares can give rise to tax at the time that you receive them. But like, you know, if the company's Canadian controlled private corporation, a CCPC, you may have heard that term, then there's no tax event on the receipt of shares. Options, on the other hand, there is no tax event on the receipt of options for anyone, whether the employer is a CCPC, whether it's not a CCPC. So there, the tax event, the earliest that there's going to be one is going to be on the exercise, and that's only if the company is not a CCPC. For Canadian controlled private companies, there's no tax event until the sale of the shares, so after the exercise, that's really advantageous because companies can use like potentially shares, but definitely options to pay their employees in a way that doesn't incur tax to the employees until much later, when maybe those employees are going to be in a better position to handle the tax hit, and the company is in a better position to pay as well, actually. Next slide, please. So as I noted, depending on the way that employees are paid, there are different tax consequences. It also depends on who the employer is, CCPC or not CCPC. Like I said, cash salary, when the employee receives cash salary, it's taxable at that time, like in that year. So the following year, the employee will fill out their tax return. They'll include that amount for sure. Stock options and shares, not necessarily the case, because they're like the tax event may not happen until the shares that they get, either like when they were given the shares or when they exercise the options, until those are sold. And there are like more fancy ways of paying employees as well, which may not be recognized in the year that you receive, like entitlements under those plans, so called deferred salary plans. But those generally aren't, they're not a huge consideration for, I think, startups until they're like, you know, a little bit more sophisticated and a little bit bigger. And finally, like if you have shareholders that are also employees, which can happen, then dividends are a form of payment as well. So dividends are taxed a little bit differently, but then if you look at the rate of tax that applies to dividends and you add the rate of tax that applies to corporations, the net of that is effectively is similar to the amount of tax that would have been paid if like the corporation had just paid salary to that shareholder. So that's called integration, and there are a lot of provisions in the Income Tax Act in order to make sure that that relationship kind of holds. It's not perfect, but it is there. So yeah, I mean, that isn't to say that it's not worthwhile to pay dividends, because in some cases, when if you're a minority shareholder, then you might want to get dividends because you don't really care if the corporation pays the tax. But generally, if you're a founder, that's not the case. So founders, often it's this, whether or not you're paid by salary or through dividends, it may not matter very much until perhaps down the line. And next slide, please. Stock options are, like I said, really useful to pay employees because they can be issued or they can be granted now when the startup or the business doesn't have very much capital with which to pay employees, but then the employees may want them because they have the potential to accrue a lot of value, and then down the road they can be exercised, and then the shares can be sold, and so it could be like effectively like a form of savings plan for the employees. So a lot of uses to them. They get really good tax treatment. You can issue them to anyone. They can be issued to founders. They can be issued to employees. They can also be issued to consultants. The tax consequences to each are a little bit different. One of the other main reasons why stock options receive the beneficial treatments that they do is that there's like value in having like key employees being aligned with the goals of the business venture. If like the employee and the company have like the same goals, then it might be that they're more likely to realize them. Like I said, stock options receive that beneficial tax treatment because although almost anything received by an employee from an employer is usually considered employment income, these stock options are like the main exception to that rule. Next slide, please. In terms of like how the taxation works, if most startups are Canadian-controlled private corporations, because in order to not be a CCPC, the startup would have to be either controlled by a foreign entity, so either somebody who doesn't live in Canada or a company that doesn't, or be controlled by a public company. So that means that there's going to be a large shareholder which is listed, or some combination of the two, like the company's controlled by non-residents or shareholders which are public. So usually that's not the case for startups, and so they would be CCPCs, and CCPCs get the best stock option treatment. As I mentioned before, the way it works is that when a stock option is granted to an employee, nothing happens for tax purposes for the employee or for the company. And then generally, like stock options may be granted with a vesting schedule, but for tax purposes, the vesting schedule doesn't matter so much. It's really when the option is granted that anything happens. And well, in terms of actual like tax conclusions for employees, like there's nothing that happens at the grant of options either. That said, if there is a grant of option for a non-CCPC, then there could be some tax consequences immediately if it's exercised immediately. Anyways, I'll get to that. So for CCPCs, if after once the option is exercised, there's also no tax payable, particularly if the share is held for 2 years. So employee gets the option and then exercise the option, and then 2 years elapse, and then the share is sold at that point. Then the Income Tax Act says that when that option was exercised, nothing happened. For tax purposes, it's when the share was sold that the tax consequences are realized. So that's quite a ways down the line. And so at that point, there's going to be an inclusion for the employee of the employment benefit, the stock option employment benefit. And the act is set up so that the benefit, like the net effect of it is that it gets treated like a capital gain. And then that's a good thing because capital gains tend to be treated at only half of a capital gain is taxable. So generally a capital gain is taxed at half the rate that a normal income inclusion otherwise would be. Particularly when there are market downturns, the details here do matter. And so, looking at the example that I just gave, so employee gets stock option from a CCPC, employee exercises it in year 1, say, and then in year 3 sells the share. Well, if when the employee exercised the stock option and got the share originally in year 1, the share had a high value. And then in year 3, when the employee sold the option, the share had a low value. Then you can be in a situation where even though the share and then the amount of money that the share was sold and the amount of money that went into the employee's hand is like little because the share wasn't worth very much when it was sold, there could still be a fairly large income inclusion as a result of the stock option benefit that gets included in the employee's income at the time that the share is sold. And so, and the reason for that is the way that stock option benefits get treated. Those are actually employment income. And so although the net effect of the act is so that only a half of that amount is included in the employee's income, because the resulting loss on the share after exercise doesn't offset any employment income, that means that the employee could be left with that employment benefit being included in their income, but no corresponding loss to offset it with. And that's not to say that there isn't a fix for that, because like if the employee had other assets that they sold and had other capital gains, then they could offset that the loss on the share with those, and there you do get like the treatment that you would want to see. But that's just something to be aware of. So if like I'm talking about this a little bit at length right now because we're in a downturn. So if employers have employees who have exercised their options and gotten shares at a time when the market value of the shares was high, and now they're looking to sell the shares, then this will be an issue for them. Okay, next slide, please. As I said, there's a different result if the company is not a CCPC. The end result is still the same. The stock option benefit that I mentioned earlier is still treated as if it's like only half taxable. It's still employment income, and so, but the main issue here is that in order to get to the position where only 1/2 of the stock option benefit is included in income, the stock option has to meet a few conditions, actually a number of conditions. The main condition is that at the time that the stock option is granted, the underlying value of the share, the strike price of the option, so the exercise price for the option, must be at least the value, like the fair market value of the share at the time of the option grant. So if that doesn't happen, then the deduction that kind of makes all of this work goes away. And similarly, if the option is granted to somebody who's not at arm's length with the company, so this would be a founder, possibly, then again, the deduction for the stock option benefit will go away. And so there are a number of other conditions as well that are more technical, like the type of share that can be the subject of the option. You can't have preferred shares and all this stuff, fancy shares, but if you do meet all of those conditions, then the end result is still the same as in the CCPC case. The timing is a little bit different because the stock option benefit is actually realized at the time that the option is exercised rather than at the time that the resulting share is sold. But like the goal is again to replicate the capital gains inclusion rate as if you had sold the share with like a cost base of the exercise price. Next slide, please. So as I mentioned earlier, stock options can be issued to non-employees as well, particularly contractors and consultants. they don't actually get the same benefit of the deferrals that employees do because they're not employees, and so they're not subject. They're not. They can't rely on the same provisions that employees can under the Income Tax Act. And for consultants, when they receive options, they received something for their services, and that something has a value, and the value of that thing has to be included in their business income. And and it's in fact like a good idea to do that. It's a good idea to try to value what that option is and to put a fair value of the option into the consultants included as part of their taxable income for the year. The reason for that is that if like this is done fairly, and like options there are ways of pricing options out there, like there for example, Black-Scholes models, lots of other models that can be used to try to price the options. But like if the contractor includes a fair value for the option in their income in the year that they receive the option, and then at the time that they go to exercise the option, arguably there will be nothing that happened, like there's no tax event at the time that they exercise. The alternative is if they don't include a fair value at the outset, then CRA may come along and say, actually, when you exercise that option, you did have a tax event then, and then the full value of the share that they could get, which potentially has a much higher value than the option value. So the full value of that share could be included in the income of the consultant, and that's a bad thing generally because the consultant doesn't actually have any money to pay the tax with as a result of like that inclusion potentially. Because well, unless that of course that a consultant wants to and can sell the share in order to fund the payment of the tax. So those are problems that I don't think consultants want to be in the position where that happens. So it's a good idea to try to figure out what the value of the option is in the year that you receive it as a consultant, and then to include that in income. Next slide, please. Okay, so the other big issue that startups encounter is that often they'll be dealing with non-residents. Particularly right now, we're pretty much in an entirely remote economy. Everybody's working remotely, and it doesn't really matter if I'm sitting in like at home right now and giving you this talk, or if I'm in Canada, or if I'm sitting somewhere in the US or other parts of the world and giving this talk. I can still give the talk. So it's really easy to do a lot of the things that you would do in order to run your business and do those things with people who are not inside Canada, except the tax consequences as a result, like they differ quite significantly if a business works with non-residents as opposed to residents. So by non-resident, I mean non-resident of Canada for tax purposes. And similarly with non-resident consultants. So the biggest issue, like I find, is that if you have an employee that doesn't live in Canada, then there could be a risk to the company that wherever that employee does live, like the company is doing business in that jurisdiction. And so the company may be required under the laws of that jurisdiction to comply with the tax rules that are applicable in that jurisdiction. And so that's called what I call PE risk. So PE stands for permanent establishment. And so if a startup has an employee in like another country, so for example the US, then just by virtue of having that employee there, it could be considered to be carrying on business in the US, and it could be considered to be carrying on US business in US, like in a particular state. And that state taxation might apply, and the US taxation, like the tax code, may apply as well. And if not, like even if there's no tax owing in the US, in that example, there could be compliance issues. Like the US has a pretty comprehensive compliance arm of it. In order to even show that you don't have any tax that arises in the US, you might have to spend quite a bit of money on professional fees and all that. And so that's a headache to be avoided, in my view. And there are ways to structure your business so that you do avoid it. the easiest way is to not have employees that are that are living in another country. And so if your business is working with somebody that's not located in Canada, then the best way to do it is to have that person be a non-resident contractor. And so other issues with non-residents are that, well, if you have employees that are coming into Canada that are not tax resident in Canada, then even though they're not like from Canada and they're not tax residents of Canada, there is still like the same employment withholding regime that works in terms of like the income that non-resident employee earns in Canada. And so there's withholding, and a lot of employers miss that for employees that come into Canada to do like a little bit of work, but and not too much, and then employers don't withhold. In actuality, they're required to. So there's also withholding if there's non-resident contractors. So again, contractors that are not tax resident in Canada but come into Canada to perform some services for the company, in which case there's called Reg 105 withholding. So Reg 105 withholding requires that the company hold back 15% of its service fees payable to that contractor and remits that to the Canadian government. Next slide, please. Yeah, and
Okay.
Good.
Okay, so I say next thing we're going to move into, and I guess before we do, thanks for sticking around for the first hour. I see that we kept probably 95% of you, so some of those are very dense topics. But I can tell you, as I mentioned, a lot of my practice is later stage financing work and M&A work, and I know we were looking at stats, and our team in 2019 and the beginning of 2020 is somewhere near $1 billion in VC and M&A work, just in kind of the Western region in the technology space. So all of that is to say that when we're at that point in a company's life cycle and we look backwards is when we can see the importance of a lot of these early stage planning decisions, early stage ownership decisions, structuring, tax issues, employment issues. I can't tell you how many times we've been at the goal line with a sophisticated investor, and that investor's advisors have discovered that unfortunately employee number 2 never signed an IP assignment agreement, and employee number 2 thinks that they actually own a part of our widget, and that's a major issue. And so while I think it's accurate and valuable to provide you with that guidance, to turn it back to a positive note, many of these early stage issues can be solved with engaging your lawyer and accountant and making sure that everybody's on the same page. And many of the documents that we're talking about will be provided, relatively tried and true, battle tested from any counsel that's got a lot of experience in this area. So it's never rewriting it's never reinventing the wheel, if you will, usually. And so I just wanted to kind of interject at this point in the discussion to give you some of that commentary. Next thing we're going to talk about is advisors. So what are advisors? Advisors are non-board experts that often have subject matter expertise in your field. They advise the board and are usually just compensated with some sort of option-based or equity compensation. So oftentimes you'll have your startup will be getting off the ground, and you'll have somebody from industry or education or somewhere else that's been extremely good to you, given of their time freely, but doesn't want to have a more formal engagement with your company as a board member or otherwise. And oftentimes that's the right fit for the advisory panel. It's somebody that can provide you with that strategic advice on it from a bit more of a removed perspective.
Okay, so I'll go go through the next slides pretty quickly. Conflicts of interest, we just put this in here just so everyone keeps in mind that obviously with different shareholders, different directors, even an individual, yourselves as a shareholder and a director, there will be conflicts of interest that exist. If you are a director, as John mentioned, in the end, it goes to your fiduciary duty to the company that you have to act in the best interest of the company. But with that being said, obviously, there can be individuals who are, a shareholder, employee, a director of the company. They'll have different conflicts of interest depending on which hat they're wearing at the time. Within other companies, for example, you have a couple experienced directors on your board who are also directors of other companies that, if there is a transaction or what have you between these two companies, obviously they'll need to disclose and let your company know what's going on and their biases. And there can be conflicts obviously between your company and various other contracting parties, your shareholders, other investors, employees, etc. So just keep that in mind as your base grows. These issues may grow with them. So on the next slide, we talk about initial corporate structuring. Just a couple points on kind of where to incorporate. So pretty much every jurisdiction will have some sort of corporate law that will allow you to create a company in that jurisdiction. And here in Canada, we hear a lot about companies incorporated in Delaware, offshore, Virgin Islands, things like that. Our kind of point of view on this is, unless there's a compelling reason not to incorporate in Canada or BC, oftentimes that's probably the most simple and will create less headaches. BC generally has a pretty friendly corporate law, pretty modern corporate law. So one example being what John mentioned earlier, there's no residency requirement for directors. So you can have all your directors offshore, all your directors in Ontario, what have you. So that's just one thing to keep in mind. We have a list of other issues. Investors sometimes don't like offshore companies, so it creates financing issues. Sometimes you'll be limited in what government grants you can get in Canada because they're only available to Canadian companies. There could be taxation, employment issues. They will become simpler if you're a Canadian, a BC, a Canadian company. John mentioned earlier, but there is a federal statute, the CBCA as well, in Canada, which is a bit unique. You can incorporate under the federal statute. Both are fine, both are Brexit friendly, but there are some advantages to each. So probably want to look into that.
Yeah, if I could just interject, just to add a point, just from a financing perspective. Oftentimes we get a question from a company that kind of goes like, we found our investor, we're very excited. However, this group is in California and they want us to move there, or they say they don't invest in BC companies, and the company is quite nervous about that answer. That I can tell you from experience, any sophisticated investor in the United States or elsewhere can get comfortable with investing in our jurisdictions. They are very investor friendly, and if you find yourself getting that kind of feedback, what you are seeing is their personal preference. And if you unpackage that, you may find that there is very little substance behind that preference other than familiarity. And so you may find yourself making a decision that is more grounded on how conciliatory you want to be to that person's personal preferences, notwithstanding the fact that that your current structuring is perfectly acceptable from a corporate and financing perspective.
Right. Okay. So you've chosen where to incorporate. Let's just say you've chosen BC now. What's going to be in your initial? What type of shares are you going to have in your shares? So usually what we'll say is you want flexibility. You want to be able to go back to your shareholders as little as possible in order to kind of continue on with your plans. So we would suggest typically that you create, when creating a company, you create a limited number of common shares as opposed to a fixed number that you'll have to change in the future. The typical modern statutes allow you to have an unlimited number of common shares. We'll also typically suggest having an unlimited number of what we call blank check prefs. Essentially what this allows you to do is to create a class of preferred shares that you can then issue in series. And the benefit of this is that the directors can create each series, including creating special rights and restrictions under those series. And this balances for the requirement to go back to shareholders, although there are some restrictions. So again, this just gives you flexibility in the future when you have a new investor asking for certain rights that you can create them without necessarily having to go back to your shareholders, which does take time. We talk next year about financing terms. Those will typically be dictated by the investor if they want debt equity, and pricing preferences and all that. Obviously, be dictated by the investor and also your bargaining power. And just things to avoid, and this is really avoid aspects. You want to try to avoid issuing secured debt if you can, and what the reason we say that is typically, not typically, sorry, you can only have one first ranking secured debtor, and the issue becomes if you have one and a second party wants to finance with debt and is requiring to be a first ranking, you then give that current secured holder power, a bit of bargaining power over you, because they're going to have to let that next person jump over them. So, I mean, obviously secured debt often is unavoidable, and if you set out getting lines of credit with big banks, they'll require it. So it's not impossible. It's somewhat impossible to keep completely off, but if you can avoid, that'd be good. Multiple share classes. We've talked already about having various classes of shares with various rights. The more classes of shares you do get, although it creates flexibility with your investors and all that, it does create complexity. You have different layers, potentially having to go to each class for approvals and all that. So sometimes when investors come in, they like the cleaner the share structure, the better sometimes. And then corporate offer, we discussed that already.
So in terms of structuring, like tax considerations play like I would say like a large role as well. John mentioned in terms of dealing with non-Canadian financiers, like I've encountered the view from mostly like U.S. Financiers that they don't want to come into Canada and invest because it's a bad tax environment. They will get taxed when they try to exit their investment in Canada, and so on. And that's actually not true anymore. And so they just like hold on to that belief, and it's in all of their documentation. They have checklists which say that is true. And so, like just having somebody that can tell them that is no longer the case, it hasn't been the case for the last 10 years, that goes a long ways towards, convincing them that it's okay to invest in your business as is without going through like, a lot of hoops in order to be in a position to get that investment. Anyways, that's one way in which like tax issues could play a role. And others, in terms of like making the decision between whether you want an investment by way of debt or if you want your investor to have shares, tax issues play a role there too, because if your company is a CCPC, we mentioned CCPC earlier, Canadian controlled private corporation, then you're able to like get a better form. Well, you have a number of advantages. One of which is that the stock option deferral works for you better. Well, if your investor is non-resident and you're considering whether to issue equity or debt, well, an issuance of equity will put you in a position where you're more likely to not be a CCPC, because that investor is non-resident and now will, after the investment, own shares in your company. And if there are enough of those, then the company is no longer Canadian controlled. And so it might be in that situation potentially better to go with debt, have that investor take on debt, and so that's a like one way a tax consideration could come into it. Another is that, well, now that you've determined that it's okay for this investor to get equity, well, how do you deliver the equity? Should you create a new class of shares? Should you have like an existing shareholder sell their shares? There are different tax consequences that attach to each. And so making the decision between one or the other requires a consideration of like how that'll affect the existing investors, the founders, and like, you know, what their tax situation will be as a result of that, and also like whether the investor wants to take existing shares versus new shares, and so on. So a lot of it depends on context, like what's happening at that time to the company, with the company. Yeah, I echo what Sam said, which is that it's easiest and best to have a simple structure and then have it be easily adaptable than to start with a structure that's very complicated and is built for a lot of different contingencies, because often those contingencies don't really matter, and it's like the issue that arises is one that's still not within those contingencies, and now you have to deal with this complicated structure. And next slide, please. I've just noted down a couple of advantages that CCPCs have over non-CCPCs. So one is that, like, one of the main ones is the stock option deferral, so the enhanced stock option deferral for employees. Another is that they have a lower rate of taxation on their first $500,000 of income, and that the discount from the regular rate of tax is about 16%. And so small businesses are taxed at the rate of 11% in BC on their first $500,000 of income. On the remaining income, they're taxed at a rate of 27%. If you're not a CCPC, then you don't get the any discount. So all of your income is taxed at a rate of 27%. There's also one big advantage for shareholders is the lifetime capital gains exemption. And so shareholders of CCPCs, when they sell their shares, if they meet certain conditions and if the company is an active, like if it's carrying on enough quote unquote active business rather than investing in like investment business, then it might be that the shareholders, when they sell their shares, they're exempt on about almost $900,000 worth of capital gains on those shares, which in like dollar terms would mean that, like, a tax savings of around $270,000, which is like quite a bit, and that's for each shareholder, depending, of course, on like the sale price of the shares. So that's a big reason to fall into the CCPC regime. Another is if the company is carrying on shred activity, then there's an enhanced shred credit that's available to the company. And most importantly, not only is like the amount of credits increased, but the fact that they're refundable. So if the company doesn't have income, then it can still claim shred credits, as opposed to a non-CCPC, which can't do that because they're not refundable anymore. There are other reasons too, but those are the big four in my view. Next slide, please. So if the company would like to qualify for CCPC status, well, that restricts who can receive equity, as I mentioned earlier. So the magic number is 50%. So like 50% of the shares of the company cannot be owned by persons, so companies, entities that are either public companies or non-residents, so non-residents of Canada. And so if all of those people and companies and entities together, like the bad holders together, own 50% or more of the shares, then the company is no longer a CCPC. Importantly, like VCC shares don't get counted in this. And so there is a VCC, so this VCC stands for venture capital companies, capital corps. And so those shares don't get counted in determining whether a public company controls the CCPC or not, or the corporation or not. Depending on like what the situation is, there's ways around to deal with this 50% issue. It could be that like enough bad parties hold shares in the company that it should be a non-CCPC, but depending on like the agreement between all of those holders and all of the shareholders in terms of who can elect directors and so on, it might be that possible to still attain CCPC status and still be able to gain benefit of all of those programs that we just talked about. And if that's the situation, then it would be a good idea to reach out to your lawyer.
Great. So the next section we're going to talk about is starting to talk about more details about who owns what. And so the first piece of that is who owns the first blocks of shares or the founder shares. Founder shares are just a colloquial that is a term that's used to describe the initial issuances of shares to the people that are creating the business, in large part to recognize their sweat equity. And because they're all there at the start, that is why the price is so low, because the value hasn't been created yet. Now, of course, there's many examples where something's been created that gets vended into the company at the same time, and so there's lots of caveats to that general statement, but largely that's the summary of what founder shares are. So in our experience and in what we recommend is founder shares consist of a most basic block of common shares with standard rights and restrictions. They should be issued to founders and senior officers, people that are there at the beginning. There's often a misunderstanding of how founder shares can be dealt with after the incorporation of the company or after the organization of the company, specifically after events have occurred where the company has grown in value. Oftentimes people say, well, if Hardeep has 3 million shares, Sam has 3 million, and John has 3 million, and we're all going to go off and start our business, let's issue another 3 million into the ether, put it in a bucket, lock it in a drawer, and won't that be great? We can give that 3 million to fourth person Angie when she joins the company, and that seems really simple. And there's many reasons why it's not so simple, and I think Hardeep's touched on a lot of those. But I think the takeaway that you want to have from that is that there's a lot of importance around who gets issued those first shares at a point in time when the company is at a very low value, and there are many issues that arise after you've hit certain points of value inflection, where there are additional tax and corporate issues around recalibrating that ownership structure. Okay. I had mentioned that founder shares are often for sweat equity. Well, of course, that presupposes that you're going to go sweat, right? So if in my same example, let's say the four of us, Hardeep, Sam, Angie, and John, have founded a company, we've likely sat around the table and all shaken hands that we're all going to be around for many years. So you can imagine how mad we would be if Hardeep wins the lottery and decides to go sit on a beach for the rest of his life. So what we do there is provide contractual rights for the company to repurchase those shares in the event that one of those situations arise. And in many times, and we call that reverse vesting, and I touched on that at the outset. So you can provide for unexpected outcomes like that early on, and a reverse vesting agreement would be a great example of something where if you're using experienced counsel, they'll be all over this issue and will be able to tell you whether that's appropriate for you. But you can provide for mechanisms to deal with the unexpected issues around who's contributing what, and if that's different than the assumptions that you made at the outset. One other thing to mention at this slide is one of the things we run into with founders that come to us after they've incorporated and are looking to kind of clean up the company before a financing comes in is have a think about how the company's issued capital should look. Now, there's in large part this is aesthetic, right? There is no legal difference between owning half of a company because you own one of 2 shares and owning half of a company because you own 1 billion of 2 billion shares. Like legally, you own half the company. However, the reason we would recommend putting together a more common founder ownership package of, in this example, 4 to 8 million shares is because it sets the groundwork for a more common outcome to the next set of share issuance events. So whether that's a financing or perhaps that's somebody got options, they exercise them. In my example, sometimes when companies come to us, when we look at the books, the founders have each issued themselves 50 shares. Seemed reasonable at the time. But you can imagine that if those two founders hire somebody and that somebody says, well, I'd like some options, and you talk to your lawyer and they say, well, senior engineer, early stage, give them 1% or give them 2%. And you go to them and you say, great, I've got this option for 2 shares. Well, that from an optical perspective, they might say, well, that doesn't feel like very much. And then you can imagine that if an investor invests in you and they're getting a very small number of shares, there will be more examples like that where you will lose the flexibility that a larger share capital provides to deal with the various equity holders that may come up as the company's life cycle goes forward. So we talked a little bit about the founders and initial ownership, and now we're going to talk about the financing plan. Often one of the kind of gating items, I would say, is developing a financing plan, often baked into your pitch deck. I know that there's a lot of great resources that you guys are getting on how to put together materials for investors. And we would just echo the importance of that I know you're getting from other advisors and other lectures like this. But I think fundamentally, just to revisit that issue, what you're going to see is expected there is, tell us your milestones. What are they? When are you going to meet them? How much money do you need to get there, right? Based on the answers to those questions, why are you asking for X dollars? What is X dollars going to get you? Because investors are going to want to see that, okay, you're telling me a story where $1 million makes sense. The $1 million is going to pay for this set of raw materials to make widget, this group of people to put it together and develop IP, and build this kind of critical amount of value in the company for the next stage. So sources of funding. So we look at a variety of sources of funding. Oftentimes, and especially for scrappy early stage companies, you're thinking of, okay, well, what non-dilutive government grants can I get? I know that equity investment, the debt investment from arm's length parties, from investors, angel investors you see in the community, VCs you hear about in the community. I know that's all there, but I also know there's a lot of great government programs, and there are tons. Everything from IRAP and SHRED, industry-specific organizations, environmental grants, quasi-government organizations, BDCs in the news a lot, and we'll talk about that in a bit. Genome BC would be another example, and so there's a lot of information available out there. We've written on it on our website. There's a lot of information available from New Ventures, and so I would encourage all of you to exhaust all of those resources online to figure out, okay, which program can I qualify for, and what do I need to get there.
Yeah, so I just wanted to say a bit about COVID-19 because that's an additional source of funding for a lot of businesses right now. And so generally, the idea is that for businesses that are not able to carry on business and because they can't earn any income right now, as everybody's practicing social distancing, then the government is stepping in to provide some like capital so that they can continue to do the same activities that they were before. The main way that they're doing this right now is through the Canada Emergency Wage Subsidy. So that program may or may not apply to startups. Generally, if the startup has some income in say January and February, and then there was a 15 or 30% drop comparison to like in March, April, or May, then they may be able to qualify for that. And that is, I think, like a really useful subsidy for startups right now, because Well, they can pay employees up to 75% of their pre-COVID wages through that subsidy, up to I think $847 a week, which is like that allows the startups to continue to employ people and allows them to continue to develop the products that they were or to carry on the same activities that they were before COVID. There are emergency loan programs run through primarily the banks, and so it provides like a low interest or no interest loans that are potentially forgivable to businesses. And so for startups that qualify for those, that would be perhaps beneficial. There are also rent assistance programs right now for companies that they normally would be working out of their offices, but they can't because everybody is social distancing, and they're also not earning income. Then they still have to pay their landlords, but the government is stepping in and saying, well, if you've suffered like a sufficient decline in business that you can't pay your rent, then the government will carry say 50% of the rent, and if the landlord agrees to discount a certain amount so that like the business pays a certain amount, but then nobody is completely out. So it's basically a maze of programs right now that are being run. There in particular, there was one program out of like through IRAP for startups that did not have any income, but like they say that the applications closed yesterday. That program had about $250 million worth of funding. It's not clear to me that they would have received applications from like enough businesses that they'll be able to actually go through $250 million of funding, but they may. And if the problem is, if there's still an issue in terms of like a lot of businesses not being able to secure some form of subsidy to help pay their employees, I would expect that sort of program would come back. All right. Next slide, please. And I think I've talked about all of this. Next slide. Thanks.
Okay, so back to sources of financing equity, and we'll increase the pace a little bit here to keep some time for questions at the end, and we'll probably just go through the break that we had planned. So sources of financing on the equity side, you're looking at bootstrapping, so the founders, so you're literally financing yourselves, friends and family, the true believers, the people that are investing in you as a person and your idea at a very early stage. Follow-on rounds, as I mentioned before, at various points in the discussion, angel investors, VCs, and then getting into a less common and examples at a more mature point in the company's life cycle, investment bankers, underwriters, IPOs, strategic partners. Thankfully, in Vancouver, our ecosystem has a large number of great angel investors and angel networks, similar with seed stage VCs. Those are the kind of early stage financiers that you're likely going to encounter at events and giving talks, and Vancouver's got a great ecosystem for that, so we're very thankful for that. This just gives you one of many examples of categories of funders and examples of numbers that we see in our practice. So I mentioned all of these. So founders, variable, you bootstrap as long as you have to. That's kind of the founder experience. Friends and family are often writing checks of that nature. And then as you can see, it goes up the chain. So angels as a group or individually, seed stage VCs are writing checks that are a little bit smaller. And then once you get to the later stage, that's when you see the large, especially at the later stage VC. That's where you see the big SoftBank check that makes the front page of the newspaper. Strategic partners, variable, but also a note on strategic partners. As you grow, you may find that your key customer wants to invest in you. There may be a commercial agreement tied to that. There may be non-cash consideration that comes into play. So that's often a little bit more unique and company to company specific. One of the great programs we have in BC that many of you are likely familiar with is our venture capital programs that see a 30% refundable tax credit for BC residents. Very popular. It often drives the deal in early stage financing, is the tail that wags the dog, if you will. But deservedly so. It's a great incentive many times for early stage investors. There are registration requirements that your legal counsel can take you through. You do need to register. There's certain minimum initial investment requirements and other requirements that you can make sure that you meet. Very briefly, you have to have 75% of wages paid in BC, 80% of assets in BC. Those are two of the more important threshold questions. We did have initially a break contemplated, but given where we are at 4:30, I think we'll just move through that and have Sam take us through some of the securities issues around issuing securities.
Sounds good. There's a lot of questions.
Okay, so I'll try to move quickly here. So there's often a bit of a confusion on if securities laws would apply to a company that isn't public or isn't listed on a stock exchange. The general rule is that securities laws apply generally to Canadian companies and to companies issuing shares to Canadians or any securities Canadians. If you recall earlier in the presentation, we had mentioned there are limits on how a company can find or sell to shareholders, and this is where the securities laws come in. So what we're trying to do right now in this section is to really speak at a high level on understanding the requirements of Canadian securities legislation with respect to selling shares. Obviously, you will want more specific legal advice if you're trying to get through this process of a financing or a transaction. So just a couple things to keep in mind: the securities laws can differ between provinces and will differ between Canada and other foreign jurisdictions. Other foreign jurisdictions will have similar securities laws to have to deal with, to navigate. So starting from the beginning, the general requirement when selling a share in Canada is that you need to either file a prospectus or rely on exemption from the prospectus requirement. Typically, filing a prospectus to distribute shares is what a large public company, for example, would do on an IPO. It's a document that's incredibly detailed, has financial statements for multiple years, etc. The concept in Canadian securities laws is investors should have full, plain, true disclosure and understand what they're investing in, and that's what the prospectus is for. In the case of non-public companies, you likely won't be producing a prospectus. Once you produce a prospectus, you become public. So what you need to do is that second thing which is rely on an exemption. The exemptions allow companies to raise equity funds from certain investors and complete certain transactions where shares are involved without having to give this full disclosure that you would in the prospectus. And there's various policy reasons for this. So this slide has a list of kind of the common exemptions that startups could rely on. Just to keep in mind, with these exemptions, there are legal documents around the financing transactions that would rely on these exemptions that often will need specific language in order to rely on the exemption, to clarify what the exemption means and the ramifications for the investor. Often it requires the potential investor to make certain reps to the company so that they can so the company can say they did the due diligence in determining if these exemptions apply. There also could be specific forms that need to be filed or completed, etc. So as a running theme, we would suggest legal advice before relying on these exemptions. Okay, so the first one is this friends, family, and business associates. As John mentioned, friends and family would be a common source of funding early on. John, next slide. Under this exemption, a company can sell to certain individuals, either directly or indirectly, who have a connection to the people running the company. So the idea is that because of this sufficient connection with the decision makers, they don't need this full disclosure on the business because they can kind of go and find out this information. So who this is would be directors, senior officers, control persons, the people actually running the business, family members of the directors, senior officers, control persons. And then it would also include close close personal friend, close business associate of directors, officers, control persons. One thing to keep in mind, there is no limit on how much can be raised or the number of purchasers, but as we mentioned before, your cap table can get a little unruly if you have a lot of shareholders. We do point out just because this exemption can seem pretty expansive, it is tighter than you know, as you first read it. You can't issue to any friend and family. It has to be there's a focus on that word close friend and family. So someone is not a close personal friend, for example, because they belong to the same organization or religious group association. They were a client, a former client, or they're connected on social media, for example. The non-legal test we often mention, often Faskinites will mention, is you have to at least know the number of bathrooms in that person's house, that director's house, or what have you. The Canadian securities regulators do have programs that will go out and look at filings and see how many times you've relied on this exemption, because I guess securities regulators don't believe that you can have more than kind of 50 friends. So you do have to be somewhat careful when using these and make sure that you're focused on the right people. The next one is the accredited investor exemption. Generally, the thought here, the policy here is that those who fall under this definition, the idea is that these investors are either sufficiently sophisticated in these type of financing transactions to evaluate the risk, and in part they use kind of as a proxy if you have the financial means. If you reach certain threshold, they I guess assume that you do have this sophistication, and because you're sophisticated, you don't need the full disclosure of a prospectus. So again, accredited investors, there's no limit on how many and how much you can raise from them. So accredited investors, what does it include? It includes financial institutions, registered advisors or dealers, which are basically certain individuals registered up to be able to deal in securities, your brokers and underwriters and things like that. Pension funds, mutual funds, certain mutual funds, and corporations, limited partnerships, or trusts with a certain threshold of assets, which is 5 million. And then you get to the individuals. Often this is the most useful categories of the accredited investor. Definitions are quite detailed on how you calculate things like financial assets and whatnot. But effectively, it's individuals who have at least $1 million in financial assets before taxes calculated in a certain way. Individuals who have net income greater than 200,000 or 300,000 when combined with the spouse in the last 2 years, and can reasonably expect that will continue. And then individuals with at least $5 million in net assets. And again, net assets is calculated in a particular way. The next is the private issuer exemption. So this exemption you'll see is kind of a amalgamation of the two previous ones with one caveat. It lets you sell securities in any amount without any disclosure to directors, officers, employees, control persons, family members of those same people, close family and friends, security holders, accredited investors, etc. So you'll see it's kind of similar to the friends and family as well as allowing to selling to accredited investors. The difference here is that you have to fall under the definition of being a private issuer. So John, if you go to the next slide. So private issuer in this case isn't necessarily just a non-public company. There is a specific definition. So this is again where that 50 shareholder threshold comes in. If you have to have, for example, less than 50 shareholders, excluding employees and former employees, there have to be certain restrictions on the transfer of securities in your articles or bylaws, and you can only have sold to people who fall under that same definition that we looked at before. So the last bullet point can be tricky. For example, if you issue options to a consultant who doesn't fall under one of the categories we had on the previous slide, potentially you can lose your private issuer status. So look at the next slide. We talked about losing private issuer status. Once you lose it, you can't go back. So once you are no longer a private issuer, for example, if you broke that 50 shareholders threshold, just because you drop back down, it doesn't mean you're a private issuer again. Once you lose it, it's gone. With that being said, losing private issuer status doesn't mean you're now a public company and you have to, you know, do audited financials and publicize them and whatnot. Still rely on the friends and family, accredited investor, and some of these other exemptions. You don't lose that. Really, what it requires is that you'll start having to do certain regulatory filings if you raise funds. That is the major difference. But it is nice to be able to rely on the private issuer exemption if you can, because you can avoid those filings. Okay, the next one is the $150,000 exemption. This only works for non-individuals. So if you sell securities with a value of $150,000 to non-individual investors, you don't need to provide that prospectus that we talked about. Keep in mind that the entity must have a separate purpose and can't be created solely to rely on the exemption. So you can have 3 individuals who want to buy, you know, 50,000 each, but can't rely on exemption. They can't just pool their money, form a company, and invest. That won't work. There has to be kind of a separate purpose for the company. Next one is this startup crowdfunding exemption. I won't go into it too much. It's one of the newer exemptions that popped up somewhat recently when crowdfunding became popular, particularly in the US. It has a bit of a limited use because of the restrictions. If you look at it, in particular, that $1,500 restriction for each investor. Obviously, if you're raising, you know, $1,500 from a few people, in order to get the capital you need, you end up with a pretty large number of shareholders, and that creates practical issues. But the practical issues we discussed before. But so the crowdfunding exemption, like I said, it kind of does what you expect the term to be, but it's much more limited and narrows kind of the portals you can use and whatnot. So the next one is the offering memorandum exemption. Again, you can sell securities to anyone in BC, and there are similar rules across the provinces and territories. If you deliver an offering memorandum with certain information in it, and then you obtain risk acknowledgement forms, although the rules kind of differ across the provinces. So basically, this offering memorandum is similar to a prospectus. It's pretty detailed, high level of disclosure. You see it from time to time, relying on this exemption, but typically you try to avoid it because of the expense of putting together that OM, and you often will end up with a large number of shareholders because basically you're trying to invest from non-accredited investors. So typically you'll be raising less from each person. You'll need each person to sign a risk acknowledgement liability a form that acknowledges risk and liability. It's a clear, blunt statement of risks. You know, you have to keep a copy and give a copy to the purchaser. The other tricky or difficult or risky part of an offering memorandum is that if it has a misrepresentation, the purchaser has a right of rescission, which means that they can ask for their money back, or a right for damages. So obviously, producing that document is time consuming, but also risky. And I think the last one we're talking about here is the employee, director, officer, consultant exemption. Under this exemption, an issuer can sell securities in any amount without providing any disclosure to its employees, directors, senior officers, or consultants, provided that the purchaser is buying the securities voluntarily. So this means that the purchaser can't be persuaded with a promise of a job or continued employment, things like that. A consultant, there's a specific definition for a consultant that the consultant will have to fall under, but it's generally an individual that provides consulting, technical, management, or other services to the issuer under a written contract and will spend a significant amount of time and attention to the affairs of the business. For example, this exemption will often be used to issue options to employees. So keep that in mind as well. Just because you're issuing options or other compensation, security compensation, you also need an exemption for that. So yeah, so I think that's it for this one.
Great. So the final section that we're going to go through, and we'll go through it rather quickly just to ensure that we leave at least a little bit of time for comments, is some of the legal agreements and considerations around raising money. Obviously, as you're starting to get a sense, there are many different kinds of vehicles to raise money in, and so we're just going to touch on a few at a high level. What I will say is, with respect to early stage investment into high growth companies, there are a couple of regimes where somewhat standard paperwork has been created that sets a bit of an expectation as amongst company and an investor, whether that be angel or early stage institutional investor, about what an agreement's going to look like. There's going to be a basic understanding of what a subscription agreement is going to look like for common shares or for preferred shares, for convertible debt, or for a SAFE. And so we can talk about some of that. Oftentimes, one of the first questions we get is, I need an NDA because I want to talk to somebody, whether it's to invest in my company or in the commercial context, and I don't want to show them any of my secret sauce without an NDA. So that is what that agreement would do. It can be either mutual two-way if both sides are exchanging confidential information, or one-way if it's just you showing them your information, which would often be the case if an investor is looking at you. Many times investors will have problems signing an NDA as a matter of principle, and so what you have to do is you and your lawyer can talk about this and make a strategic decision. Number one, about what it is that you show them to get them over the line and make that investment, and number two, really kind of stress test whether the things that are the secret sauce are things that you can't show a financial investor and keep those confidential, or whether some of that can be sent to them in summary form or otherwise. With respect to term sheets, we often get asked to prepare a term sheet, and I think it's a great exercise to ensure that the key terms and conditions around a financing are fleshed out. So what we would set out is the kind of security that we're raising money through, and Sam talked about some of the considerations around securities, and so this is just a reminder, it's not just shares, even convertible debt and others. The valuation that's being done, that obviously if you're issuing shares, you have to arrive at a share price, and from that you can extrapolate what the valuation of your company is. But there's many different levers you can pull around how to value the company. For example, is it on a fully diluted basis, meaning if my company has options in it, is the investor going to say, well, for the purpose of coming up with the share price, I want all those options to be included in the fully diluted share count, or whether it'll be non-diluted, so it's just issued shares. What you'll do with the proceeds, and then what investor rights have. Investors, especially savvier investors, are going to be asking for things like contractual rights around being able to participate in the next financing, or potentially be able to buy your shares if you want to sell them. Maybe protective provisions where certain fundamental matters, especially matters that impact their shareholdings, you can't do without their approval, and potentially the ability to appoint board members or have other governance rights. A subscription agreement is where it deals with the terms and conditions around the issuance of those securities. This will contain all of the kind of fundamental mechanical terms, all of the pricing and issuance terms I talked about, but also reps and warranties about the company. And oftentimes, depending on the sophistication of the investor, the reps and warranties can be quite extensive and can speak to all aspects of the company's business, including corporate, employment, IP, tax, litigation, and otherwise. And so it would be under those set of promises about the snapshot of the company as of closing that induces the investor to make the investment, and also provides them with recourse against the company if one of those turns out to be untrue. For example, if the company didn't disclose that there was $1 million lawsuit that was in the works, then the investor may claim for their proportionate share of damages because there's a diminishment in value of the business, and therefore a lower share price that they should have paid. Convertible debt raises different issues than investment in shares. Convertible debt refers to debt, so it does have a maturity date. It often does bear interest, and absent a conversion event will be repaid with some of the hallmarks of equity. So there is a conversion right that specifies that usually upon a triggering event it'll convert into shares, often in the same kind of shares that you're giving to the investors in the triggering event, and subject often to a discount to reflect the fact that the convertible debt holders invested at an earlier stage of the company and at a more riskier stage. And so with convertible debt, you get all of the debt issues. So you get issues around security, issues around interlender rights. So if there's a whole bunch of debt holders, what rights do they have as amongst each other? Can one of them try to demand payment, or do they all have to do it together? Things of that nature. And convertible debt is not eligible for EBC tax credits. Safes are slightly different. Safes say this word safe, which you may have seen in some of the materials around the industry online, refers to simple agreement for future equity. This is a contract that's not debt. It doesn't have interest applied, then there's no maturity date. That says you will get shares at a future date, but it's what shares and at what price and how that are really the terms that you need to negotiate. Often, again, like convertible debt, this is converted at the next financing of a certain size. In contrast to convertible debt, and something that sometimes makes safes more lucrative to or more attractive to investors, is that they are eligible for EBC tax credits as of March of last year. And so so from the founder's perspective, you may say, well, this is great. I don't have to come up with a value for my share because that's really hard. I just started, I found this investor, but we really don't want to go through that fight about what it's worth. A safe is often a great tool to get around that. Conversely, I can hear many angel investors yelling in my ear as I say that. Sometimes it is very important to go through that very exercise of valuing your shares and arriving at a priced share round for those angel investors to participate in. Stock options, I think we've talked relatively at length about stock options, so I'll just skim through these. But what we wanted to do, knowing that you were all provided with the presentation in the handouts, is give you some kind of rough guidelines of what we sometimes see in the marketplace around, okay, what kind of people get what percentages of the stock option pool, things like that. We've also provided you with a cap table that spells out the a company's life cycle. And so I'm going through this very quickly, but again, it's in the handout. And what it does is it sets out different financing rounds and what that looks like for the cap table, and also what it looks like at the bottom for the founder's ownership interest. So you can kind of track through, okay, the presenters talked about, different kinds of financings and an option plan. What does that actually look like on a cap table? So this is just an extremely high level, for informational purposes, example of what a cap table looks like. We did want to leave some time for questions, so that's our contact info, which is again in the slides. Rather than having you stare at our three faces for the remainder of the presentation, I'll just leave it on the Fakun logo, and I'll just wrap up by again thanking everybody for attending the presentation. We're still at a very high number of the original attendees, so listening to three lawyers for 2 hours somehow didn't put everybody down off their computer. But so thank you very much for that. And it wouldn't be a presentation by lawyers without a legalistic caveat. This wasn't legal advice, and we do, and this was for informational purposes only. And we do recommend that you do seek legal advice from an experienced lawyer that's used to dealing with these startup issues. We have a team of them at Fakun that would be very keen to speak to you if you'd like. And so on that note, I'll turn it over to Michaela and Angie for a brief question and answer period if they have some questions teed up.
Yeah, for sure. And before we start the question period, I wanted to thank you guys so much for joining us this afternoon. And I just wanted to remind our audience that we've recorded this webinar, and the recording will be sent to you and tonight, and it will also be posted on our website. All right. Oh, and I sent out a short survey like just a minute ago, and I promise it's actually less than a minute. I said it was a minute, but I promise it's like 15 seconds. Okay, so let's do our first few questions. So how easy or difficult is it to change structure? For example, going from proprietorship in the early days to, say, a corporation after some traction?
Well, I think there's a couple of ways to answer that. I would have one answer, and Sam and Hardeep may have a slightly different answer from our different areas of expertise. I think that the high level of it is, well, I'll give you the practical answer. The practical answer is I don't think there's enough hassle in doing it right from the start and incorporating as a company to justify the premise that like the proprietorship was the easier starting point and I'll worry about the corp later. I think it's very easy to start from a corp at the beginning, and therefore it's apples to apples from ease of the starting point. But I do think you should be mindful that there can be some significant issues, especially if you've built quite a bit of value in your sole proprietorship, and there may be a whole bunch of issues around liability if you have a team around you as a sole proprietorship that you've made promises to about who owns what, or you have commercial contracts for which you have personal liability. I would strongly recommend against that approach.
Okay, good. All right, next question. So on one of your slides, you indicated a shareholder being a holdco. Can you expand upon that a bit more?
Maybe I'll turn that one to Sam because I already did one.
So holdco really just means that instead of an individual investing directly, they invest through a company, and this company, when we talk about holdcos, what we're talking about is a company that this person has incorporated for themselves for this purpose of investing, either maybe just in their company, or he has a holdco that invests in a variety of companies or whatever. And the reason for that, there could be a lot of reasons for that. It could be that he wants to have part of the share, a few of the other shareholders be his kids or something like that. There could be tax reasons. I'm sure Harvey knows could answer that. And the other could be they want to take advantage of the same things that we've been talking about are advantages for the company. So limit liability within this structure. So there's the reason for a holdco is really up to the investor. It doesn't really matter for the company.
Okay, awesome. All right, so next question. This is pretty specific. So so it's like timing a founder's shares allocation. So the plan is to attract a co-founder at some point in the future with 40% ownership in a Class A common share. However, I've also raised a family and friends Class B common round at a higher share price than the founders round. What is the most tax efficient way to transfer 40% of those Class A founder shares to the future co-founder given the gain in the share price?
I'm gonna just interject. I appreciate the attempt to get a question to answer that question. That is far too specific, and the answer is very much based on your individual structure and the specifics of your company. So we would strongly advise you to seek legal advice on that.
Fair enough. Okay, it is 5. Do you have time to stay around for a few more questions? If not, we can wrap things up now.
I certainly do. If people took the time to get the questions in, want to make sure we answer as many as we can.
Okay. No pressure. Thank you. So in the very early stage, when you are still figuring out whether your co-founders are compatible, is it better to set up a partnership option than a corporation?
Maybe I'll take that. That shouldn't be the main reason why you're choosing between a partnership and a corporation. I think really should come down to tax typically, but there are other considerations. But certainly for a corporation, you can have things like reverse vesting that John spoken of, or just a shareholder agreement that gives person X or Y a right to leave and to sell their estate to someone, or for two people that choose to remove one person.
Okay.
Yeah, I mean, like generally, like the reason why you would want to use a partnership is that it can lend more flexibility to the arrangement in terms of like how parties get paid. Whereas like a company, when you have shareholders, like there's very specific ways in which you can pull money out of the company, which is that the company pays dividends. And so I would say, like especially at the early stage, the simplest way is to just use a corporation, because it's very expensive to set up a good partnership agreement. And if you don't have a good partnership agreement, all sorts of bad things can happen, because there is no real arrangement between like people who are working in a partnership. So yeah, like although there's some context there, it's I think better to use a corporation.
Awesome. Okay. So, so for in the province of BC, the model of notice and articles for corporations, like this is what they're referring to, is this a good model to use, or are there additional clauses that should be considered and added?
I think practically the answer to that is that you know it's not, and this isn't a self-serving answer. It might sound like it is. You should take guidance from your lawyer on that, because any kind of experienced legal team is going to have a set of articles that they're familiar with, that will likely meet your needs, and you know you're going to need to engage with your legal counsel on a whole variety of issues in the future. You know, go back to my comment about AGMs, go back to my comment about, you know, increasing, decreasing directors. There's going to be a whole bunch of reasons why, you know, your lawyers need to be really familiar with those anyways. And so that's probably what I would say. Like, there's just no way without, you know, kind of running through the needs and nuances of your company, what additional clauses you may need. And I think if I could just make one more comment on just kind of some of the questions, which are number one are great questions, no doubt. I think one of the points I'll make is there's a whole bunch of great law firms in the city that offer like really good startup packages. So I want to leave people with the impression that there's relatively economic access to a lot of these early stage kind of documents and startup tools and things like that. And so, you know, if I could just put a plug in more for our ecosystem, and certainly Fakun is one of them. There's a whole bunch of practitioners around the city, and we have many at our firm that you know, acknowledge the fact that, you know, you guys are just starting out. Every dollar counts, and sure, there's the desire to do it right, but again, there's that, you know, real drain on resources that comes when you're just a brand new startup. So I would encourage people to go see what is available out there in the market. We can certainly give you information about our program if you want to contact any of the three of us. But that would be kind of my long-winded, hopefully helpful answer to that question.
Awesome. Okay, we'll just take one more question now, and then everyone else that we didn't get to your questions, again, you can contact John, Samuel, or Hardeep. They've left their emails out on the last slide. Okay, so what percentage of companies do you see register provincially versus federally, and do you recommend either or?
John, do you want to take that? I think you would need a little more, but I think in our experience as a BC firm, I think we see a lot of BC incorporated. There are a variety of reasons for that. Generally speaking, BC's corporate law is pretty friendly and modern. But with that being said, might be a bit of a bias in that we're in BC, but we do have, you know, non-BC clients who, well, one of the most popular provisions that they like to rely on in BC is the not having a resident director requirement. So, you know, a foreign company can incorporate in BC and all foreign directors, which would, for example, work for a federal company.
Awesome. Okay. Well, thank you all for joining us online, and thank you again, John, Samuel, and Hardeep, for your time today. This has been really helpful for our competitors and for all the other startups that we've had online today. So signing off, everyone, but enjoy your night and stay healthy.
Thank you.
Thank you, everyone.
Thank you.
Thanks, John, Samuel, and Hardeep. Nice to see you.